Hi, my name is Alicia Corrigan and I'm with John Lane CPA. Today I want to talk to you about shareholder reasonable compensation. This is one of the hot list items and has been for many years for IRS. And as you know, or you may have heard of, there was an increase in IRS agents. It's really like that low-hanging fruit that IRS can go after. And basically what it comes down to is if you are a 2% shareholder or more in an S corporation and you perform services for that business, you are required to pay yourself reasonable compensation before you ever take any distributions. Now, what is the difference between compensation and a distribution? Compensation is where you get an actual paycheck. It is run through the system. FICA taxes are collected on it, federal unemployment taxes are paid on it. You have state unemployment as well, but those are, the three key factors. You get a W-2 at the end of the year. A distribution is where you take earnings from the business, and it just affects your basis. And basis is a whole other topic, but basically is your earnings that you've retained in the business. Having said that, you cannot take distributions if you do not pay yourself reasonably. If you're audited by IRS, they will recategorize those distributions as income or wages, and you'll have to pay taxes on those. You'll also have penalties on those, interest on those. So this is just one of those things that is very easy for IRS to target and then to, tax and get income on. Now we know that if the income that the business is making doesn't support having W-2 wages, that's a completely different story. But in those cases, you better not be paying yourself any distributions because, again, that is a no-no. If you're going to pay yourself anything, you must do it as a W-2. Having said that, if you don't pay yourself any distributions and you are performing services for that business, we haven't seen any court cases where that has been challenged. So if you're not paying yourself distributions, but you're also not paying yourself wages, I'm not saying that it could never get challenged, but we haven't seen it in any court cases currently. It's really more so if you're just severely underpaying yourself, or like I said, you're paying yourself distributions, but you're not paying yourself W-2 wages. So I did just want to clarify that. So again, just something to kind of consider and think about. And we do offer a service for this, but basically when you're paying yourself reasonable compensation, what you want to consider is what would you pay someone to do the same duties that you are in that business? So you want to think about the individual duties you're doing. You want to think about the quality of those, how much time you're spending. All of these are factors that come into play. When we are doing our analysis on this, we also look at the demographics, so where you're located, what other companies are paying for those same type of services, that type of thing, and we provide a report. So if you are ever audited by IRS, you can just slide them that report and call it a day. Now, it's recommended that you do this every year. For our purposes, we really say every other year, or if your duties change drastically, that type of thing. But this is a great report to have in your back pocket just to make sure that you are audit proof, because like I said, there are a lot of new IRS agents. They're going to be going after that low-hanging fruit. So that's like false ERC claims, the large estates, people that are reporting extremely low income, reasonable compensation, partnerships. All of these are things that IRS is targeting, and we want to make sure that our clients and just the general public is protected and is really audit proof. So if you think that we could be of service to you, please don't hesitate to give our office a call, and we look forward to hearing from you.